Well, it's definitely part of the currency war, and it's important to understand why China is limiting the gold imports. It's not that they don't want gold. They want all the gold they can get. They've more than tripled their reserves over the last 10 years. They're a very large mining output, about 500 tons per year, the largest in the world. So they definitely have the appetite for gold. However, there's a dollar shortage in China. They have trillions in US dollar denominated external debt. They're worried about their reserve position being depleted. You know, in 2017, their reserve position went from $4 trillion to $3 trillion. So they lost $1 trillion very quickly. That could happen again. So they've got capital controls. They don't want to buy gold because it means the dollars have to come out of China to pay for the gold. So it is part of the currency wars. It may last for a while. It may not be over immediately. Now, again, important to understand their appetite for gold is as strong as ever, but they're doing this certainly as a temporary measure to limit dollar outflows. Whether it gets extended remains to be seen. It depends. Will China strike a large deal with the United States to end the trade wars and end the currency wars, at which point China might be able to open up the capital account again? I'm very doubtful. I think this trade war, currency war, really a Cold War too, if you want to think of it that way, is going to get worse and continue. So I would expect that this may impinge on China's gold imports. The good news is that the rest of the world seems to have more appetite for gold than ever.
You mentioned in your answer the dollar shortage. Do you think the dollar shortage in China and other emerging markets presents a systemic risk to the global economy?
That's a very good question. It's one I'm asked frequently. They say, well, Jim, you've outlined various scenarios, sort of fissures, cracks in the system, ways in which we could have a new financial crisis or even just a cyclical recession, maybe turning into a depression. They're different things. The business cycle and financial panic are two different things. But sometimes they can converge. They can come together exactly as they did in 2008. So the problem when you say there's a dollar shortage, people say, wait a second. The U.S. Federal Reserve printed $4 trillion between 2008 and 2014. How could there be a dollar shortage? Well, the answer is, well, the Fed was busy printing $4 trillion. The world added $100 trillion of debt. So even with that amount of money creation, the lack of velocity, the lack of expansion of broader definitions of money still leave us with a dollar shortage relative to the debts denominated in dollars. Now, China is a big part of the problem, but so is Turkey. So are a lot of other countries around the world. And people say, well, Jim, what's going to cause this financial panic? It's a long list. To me, it's less important figuring out what's going to cause it as the fact that it will happen and it will be severe. However, if you say, well, you have to give me the list, give me your top 5 choices, this would be very close to the top. And the point is, we see, for example, China's, the amount of U.S. Treasury securities that China owns is declining. People say, oh, China's dumping Treasury securities because they're fighting currency war with the United States. No, they are selling them, the amount is declining, but they need the dollars. And so that's really what's critical. So that links to why do they not want gold imports? They need the dollars. Why are they selling U.S. Treasuries? They need the dollars. And that is also going to continue. And we've seen some monetary tightening by the United States, rate increases and balance sheet reductions over the past 2 years. Now that's recently reversed. The Fed on July 31st cut rates. They also announced that they were ending their program of reducing the money supply, actually destroying money, the opposite of quantitative easing. So they have started to ease again, but the problem is, remember, monetary policy works with a lag. So what we're suffering right now is the result of policies from 2017 and 2018. We won't get the benefit of this new easing until next year. So this dollar shortage is going to get worse, and it could turn into something bigger. You see it in Argentina, Turkey, Brazil, China, and other countries. So it really bears watching. It's the kind of thing that an unexpected bank failure could lead to a worldwide contagion.
Jim, what's the likely future for Australia when its key security partner, being the US, is in developing Cold War with its key economic partner, being China?
Well, Australia is called the lucky country for a reason. It's approaching, not quite there yet, but approaching 30 years without a recession. So I don't think you get very far by predicting recession or business cycle downturn in Australia. It's got a very well-educated, productive population, wonderful natural resources, tourism, exports. It has a lot going for it. Having said that, Australia, for better or worse, is joined at the hip with China. Australia has really hitched itself to China. So if China slows down, Australia's going to slow down. There's no way it can be otherwise. So exports from Australia, iron ore, copper, other agricultural products, etc., are going to slow down. They already are, because China its growth is slowing down very, very rapidly, surprising a lot of observers. Good reason to think that China's growth the official numbers are overstated. Not a complete lie, but overstated because the account investment, it really is worthless. That an accountant would make you write off if you weren't a sovereign country. So the growth is lower than many people believe. It's probably getting even lower than that, slowing down more. That will affect Australia. The other way Australia is affected is the capital exports from China, but basically the capital flows out of China. We're coming into Australia, so the real estate boom in Melbourne, Sydney, Perth, other cities, both in terms of bidding up prices and construction, that's slowing down. We've seen property values declining in Australia. So I'm not predicting a recession for Australia. I am predicting lower interest rates and more of a devaluation of the Australian dollar against the US dollar. I know it's come down a lot already, but it will probably come down some more.
As the world's second largest gold producer, with most of that metal going over to China, how does that complicate Australia balancing its relationship between the US and China?
Well, I am continually astounded at the ignorance of gold as a valuable monetary asset in the United States. Now, it's funny, the United States is the largest gold holder in the world, over 8,000 tons. People are surprised to learn that about 78% of U.S. reserves are actually in gold. You'll say, well, what's your reserve position? Well, around the world, it's 60% U.S. dollar denominated assets, other currencies, Swiss franc, UK pound sterling, Japanese yen. There's a slice around the world for Australian and Canadian dollars as well. But the U.S. has 78% of its reserves in gold. Now, in fairness, the U.S. doesn't really need foreign currency reserves because we print dollars. But the fact is that the U.S. is a very large gold holder. Having said that, you talk to American institutions, American individuals. I've spoken to a lot of government officials, Treasury officials. They don't take gold seriously as a monetary asset. The reason that's important for Australia, if you were shipping almost anything else to China, the U.S. might think you were sort of profiting at our expense because China's put tariffs on U.S. exports to China, the U.S. has put tariffs on Chinese exports to the United States. We're fighting a trade war. Australia wins a little bit in that, as do Brazil and Canada and some other countries, because China could diversify those purchases. So the U.S. might get upset if Australia were selling a lot more soybeans, but they don't seem to care about gold, so I think it kind of flies under the radar.